Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
But let's go back to CDD and let's do another quick analysis, because we're going to talk about the same idea that we looked at in the last trade, except in reverse. In this case, we're looking at a downtrend. So the market is in a downtrend. The Canadian dollar has been strengthening relative to the dollar. But how much further do I think that this exchange rate is going to go? Do I think that the Canadian dollar is going to get to parity with the dollar, meaning it would get all the way down to 100? Maybe. I have some concerns about that myself. So I mean, I'm bearish, but do I think that we're likely to break support here at the 102.50 or so? Well, probably not. But what I could do is start to evaluate where do I think the market isn't going to go. So let's say, for example, I'm just drawing these lines kind of quick and dirty here, but I find it's a lot easier to get the point across when you can kind of graphically represent it. That way, if you want to repeat some of the work that I've done today on your own, you know what the charts look like and where I drew my lines. So our prior high was at about 108.50 or so. And I can start to look at that and say, well, how likely do I think it is for the market to get up there to 108.50, or even higher than that? What about maybe 109.50, the prior high before that? So I can start pricing options to say, well, so let's say it's 109.50. What are those options that expire in December worth, and how much premium would I be able to collect? So if I were selling calls in this case, because I'm bearish, so I think the market isn't going to go up. So if I sell a call, then those calls are going to become worthless, which is great for me because I kind of sold high, and then I'm able to either close it at a lower price or just let it expire worthless if the trade goes my way. So if I'm pulling today's prices, and these are a little bit old, so don't quote me on this because the prices have moved a little bit since I made my notes, and the market's closed today. So I mean right now, so we can't pull some current quotes. But those particular calls were selling for about $118, so $118 per contract. And what I'm suggesting is that, well, the market's not likely to go beyond this resistance level here. And as long as it doesn't, so it could drop, and in fact, it could all get all the way down to parity. That would be fine because I collect my premium. I didn't make a bet as to where it went. I made a bet as to where it's not going to go. So this is a pretty straightforward idea. Now, there are kind of a couple of things that are required to be able to understand how does this work in, if I don't have a lot of experience, what are some of the things I need to know? If you're new to options, you need to understand how strike prices work, because that's relevant to, if I want to use strike prices as part of my analysis as I'm finding support and resistance levels, which is one of the things I've been doing. I try to match my strike price to my resistance or support level. So I'm kind of creating an association there, and which means that I'm usually selling a call or a put, depending on the trend, that's out of the money. So it gives me a little bit more of a buffer zone, and I'm willing to give up some premium, where if I were selling, let's say, a call option that was equal to the current price in the market, so down here 105 or so, well, I would collect a much larger premium, but I would also accept a lot more risk. The market wouldn't have to go up as much for me to start accumulating some losses. So again, kind of this trade-off. I'd get paid more, but I'd have a lower probability of walking away with a winner, whereas you sell a little bit further out of the money, and you have a higher probability of winning. So it's one of these balances that I find is very customized, just depending on who you are and what you find to be most comfortable for you. So I got a question here as to, so let me answer a couple of questions before I move on to, because I want to show a couple more, I want to show one more example, and as to how we can start to work on, we talked about two really simple concepts: selling puts in an uptrend, or selling calls in a downtrend. I mean, this is really bare bones. This is basic stuff. I find, however, that traders too often ignore the really basic, easy trades to execute. So I'm trying to keep it really simple, but I've kind of left the unanswered question of, so how do you identify the trend? But let me answer a couple questions first, and then I'll talk about how might we look at the trend so we can decide whether we're selling puts or whether I'd be selling calls. So the first question is, what would the obligation be on that EUU puts if they were in the money expiration? Okay, so great question, actually. So what's the obligation if I were to sell a put or a call, and then it expires in the money, right? So these are European expiration, which means they can't get they don't get exercised early. They can be, quote unquote, exercised at expiration, but they're cash settled. So let's say at expiration, the call that I sold was worth, $200. Well, then I have a $200 cash obligation. I don't have to deliver anything. I pay the money. So they're cash settled. You don't have to go through. I mean, you wouldn't ever actually deliver, Canadian dollars or euros or whatever it is. It's just, however much they're worth at expiration, that's what you're on the hook for in cash. Obviously, if you want a little bit more detail as to how your broker handles exercise, you want to talk to your broker. I know a lot of traders, and I sometimes fall into this category. It kind of depends on the situation, but I know a lot of traders who they never let their options expire. They always buy them back. And I know that it's becoming more and more customary for some brokers to allow you to buy back a very, very low value option. Maybe it's worth 5 cents now or something like that. It's out of the money, and it's only worth a little bit, but they will allow you to buy it back for no commission or reduced commission rate. So you may want to talk to your broker about that too, because I'm seeing that kind of an offer thrown around a lot more these days. And a lot of traders will. They may hold on to an option that they've sold. So let's say, for example, that we were making this trade here, just hypothetically, and the market subsequently begins to drop. Well, great, because all of a sudden this option, instead of being worth 118, let's say the market drops, and now all of a sudden it's worth 50 cents. So we're in a profitable position, and we're nowhere near expiration. Maybe it drops to 50 cents because the market really starts to boogie and gets all the way down here towards support below 102.50. Well, yeah, you could definitely buy that back if you feel like you're concerned about a support bounce and you don't want to hang on to the obligation. Maybe you want to do another trade or something like that. It's really kind of a case-by-case scenario, but I don't think that would be unreasonable at all, but to close that position early, and you definitely can. Or if the option were in the money and you just felt like, you know what, I've accumulated some potential losses here, maybe the market has gone way up, and now all of a sudden our option is worth 150. Let's say the market's just really started to cruise on us, and we're at a loss. So we sold it for 118. It's now worth 150. So we're sitting on top of a 32-cent loss. Could we close it if we just decided I don't want to accumulate any more potential losses? Definitely, you could get out of it. So lots of flexibility, and the obligations, quote unquote, from being the option seller are actually quite flexible. So it makes it a very convenient market to trade.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.